Now, let me come to the accounting of national income. There are three methods. Let me first discuss about the first method, that is product method or value addition method. In this, we consider GVA of any firm is equal to the value of final goods minus value of intermediate goods plus the change in inventory. Now let me come to the inventory. What is inventory? Inventory is maybe a raw material that is not yet used to produce goods, or semi-furnished goods, or furnished goods that is not yet sold. If we want to calculate the GDP, we have to add the GVA of all the firms in the country. Firm 1, Firm 2, Firm 3. We get the GDP of the economy. And let me come to the second method. Second method is income method. We know this is easy because we already discussed factors of production. In factors of production, we discussed about the factor incomes. We have to consider the same for the calculation of this income method, national income. Wages plus interest plus rent plus profit is going to be the GDP of this calculation. This is easy. Next, let me come to the third one, that is expenditure method. In expenditure, we consider all those four sectors that we know. What are those sectors? Household, another one is farm, state government, external sector. How do they make an expenditure? Household, consumption. They consume final goods, right? Next, firms, what they do? They do investments on capital goods, machineries, tools. Government expenditure, revenue, capital expenditure, they do. And then the external sector, that is import and export. These are added together will result in this expenditure method, national income. Now let me consider another one important fact. Somebody's income is somebody's expenditure. Let me consider expenditure method and household income. In this, we know C plus G plus I plus X in X minus I. This is C plus S plus T. This is consumption. This is savings or investment. Savings into your IFD or RD or stocks or mutual funds, etc. This is tax you pay for government. Where this consumption comes from, the same thing. Here you save means you deposit into the bank. That is taken by this industry as a loan. So loan, here tax, it goes to the government. Now what if government expenditure is greater than tax? What happens? It is budget deficit. They have to sell securities or take loans from banks or international institutions. What if the import is greater than export? What happens? It is called the trade deficit. We can easily calculate like this. If the economy is closed, then there is no import and export. This is zero. Ours is open economy. We import and as well as export.